Imagine having a product that's like so incredibly popular that the more you sell of it, the worse your profit margins actually look on paper.
Right. It makes no sense intuitively.
Yeah, exactly. But that is the bizarre reality that Broadcom is facing right now. I mean, they're effectively this invisible toll booth
Mm.
on the whole AI highway, closing in on a $1.8 trillion valuation
Trillion with a T.
with a T. But at the same time, you've got these technical alarms just flashing red all over the charts. Analysts are screaming strong buy. But are we looking at the ultimate AI cash machine here? Or is this just, a beautifully disguised trap for retail investors?
I mean, that is the defining question, right? For anyone analyzing the semiconductor space today, this is it. Because the surface narrative looks pristine, you've got record-breaking numbers, huge partnerships, but the undercurrents actually moving this stock are, well, they're remarkably complex.
And untangling those undercurrents, that's our mission for today's deep dive. We're going to peel back the layers on Broadcom's financials, look at the psychology driving those technical charts, and really dig into this fierce bull versus bear debate happening right now on Wall Street.
Yeah, we want to figure out what's genuinely powering this juggernaut and where the vulnerabilities are hiding. But before we get into the heavy math and the market mechanics, just a quick, clear reminder for everyone.
Always important.
Right. This deep dive is strictly for educational and analytical purposes, guys. It's not financial advice. We're just here to break down the data so you can, go do your own research.
Absolutely. Do your own due diligence. And hey, while you're at it, do us a quick favor, hit that like button, subscribe to our YouTube channel, and I'm explicitly asking you to leave your feedback and thoughts in the comments below. It is compulsory.
Yep, you got to do it.
We read every single one, and it really helps shape where we go next. Okay, so to really grasp the Broadcom story, we need to establish the sheer scale of what we're looking at. We are talking about a true market titan here.
Oh, massive. I mean, the velocity of their recent growth is it's staggering. So Broadcom closed at $371.55 on Friday, April 10th, 2026.
Right.
And they logged a 4.69% intraday gain just on that single Friday.
Which is wild.
Yeah.
Because moving a stock of that size by nearly 5% in one trading session, that requires an unbelievable amount of capital. I mean, that puts their total market cap at a staggering $1.76 trillion.
Exactly. It takes intense narrative momentum to move the needle that far. And the catalyst driving this is twofold. First, they reported record quarterly revenue of $19.31 billion, which is a 29.5% increase year over year.
Huge growth for a company that big.
Yeah, it really is.
Yeah.
But the second piece of news might actually be more critical to the long-term story. They announced a newly extended long-term AI partnership with Google that runs all the way through 2031.
Oh, wow. I mean, in the tech sector, 2031 feels like a completely different century.
Right. It's an eternity in tech.
5 years of locked-in collaboration. That provides this incredible floor of predictability, right? It means they aren't just selling Google an off-the-shelf piece of hardware. They are co-designing the architecture that Google's future AI models will actually run on.
Precisely.
But, if we zoom out and look at the 52-week history, the ride has been anything but smooth. In April 2025, just a year ago, the stock hit a low of $161.61, and then it skyrocketed to $414.61 by December of 2025.
It's a total roller coaster. And when you see that kind of explosive volatility, the immediate analytical reflex is to look at who is betting against the company, like who's taking the other side of that trade.
The short sellers.
Exactly. And right now, the answer is almost nobody.
Wait, really?
Yeah, short interest sits at just 1.15%, which is about 53.37 million shares. So short sellers are essentially refusing to step in front of this momentum. And furthermore, if you look at the internal corporate side, there hasn't been any significant cluster of insider buying or selling in the last 30 days either.
So insiders are just holding their ground, letting it ride.
Basically, yeah. They're letting the current market dynamics just play out.
I was trying to think of the best way to visualize what Broadcom actually does for you, the listener. Because it's not a consumer brand. You don't buy a Broadcom phone.
No, not at all.
So I like to think of them as this invisible infrastructure of the modern internet. Whether you're scrolling Meta's platforms or querying Google or using Anthropic's language models, Broadcom is just quietly sitting there in the background collecting a fee for the networking chips that allow those massive servers to even communicate.
That's a great analogy. They lay the digital asphalt. They design the custom silicon, the really highly specialized chips that allow tens of thousands of processors in a data center to actually talk to each other at the hyperfast speeds you need to train AI.
Right. And that narrative is super compelling, but hype and headlines are great, right? A good story isn't enough to justify a trillion-dollar valuation on its own.
Hmm.
So what happens when we actually lift the hood and look at the engine, like the raw financials?
Well, the income statement for the quarter ending January 2026 paints a very clear picture of their operational strength. Out of that $19.31 billion in total revenue, their net income came in at $7.35 billion.
Over $7 billion in pure profit in 3 months.
Crazy, right? And their trailing 12-month diluted earnings per share, or EPS, is $5.13. Looking ahead, their EBITDA, which for the listener just gives us a look at operational profitability before things like taxes and depreciation, is projected at $35 billion for fiscal 2025.
35 billion. Wow.
Yeah, it's a massive number. But this brings us right back to that phenomenon you mentioned at the very start of the
Of
show.
the margin paradox.
Exactly.
Because their gross profit margin currently sits at 65.57%, which, look, keeping roughly 65 cents of gross profit on every dollar sounds incredible to a casual observer. But that margin is actually falling. It's down by about 90 basis points.
And here's the fascinating contradiction. They are experiencing margin pressure specifically because they are selling so many custom AI accelerators to companies like Google and Meta.
Which feels completely counterintuitive. I mean, they're selling more of their hottest, most in-demand product, but they're making a lower percentage of profit on it. Like, walk us through the mechanism there.
Yeah, it comes down to the difference between bespoke and off-the-shelf products. So custom silicon, these chips, designed specifically for one hyperscaler's unique data center architecture, historically carry slightly lower gross margin than Broadcom's traditional standardized networking chip. So as the custom AI side of the business explodes and becomes a much, much larger slice of the total revenue pie, it naturally drags the average margin down slightly.
I see. So it's a trade-off. They're accepting a slightly lower margin percentage because the absolute volume of dollars coming in is just so astronomical.
Precisely. You might make a slightly smaller percentage, but you are depositing significantly more actual cash in the bank.
Okay, that clarifies the income side perfectly.
Huh.
But when I was reviewing the balance sheet from our sources, there's this massive elephant in the room that just stops you in your tracks.
The debt.
The debt.
Yeah.
Total assets sit at $171.09 billion, but nested inside their $89.80 billion in total liabilities is $66.1 billion in total debt,
Yeah, it's a huge number.
mostly stemming from that massive VMware acquisition.
Hmm.
So my pushback here is, how does a company with over $66 billion in debt realistically operate with any agility? Like, how is that financially healthy?
It's a completely fair question, and it is the primary target for the skeptics. But to understand why the market tolerates that debt, we have to understand why Broadcom took it on in the first place.
Okay.
The semiconductor industry is notoriously cyclical. It goes through periods of massive boom and bust. So Broadcom acquired VMware to diversify into infrastructure software. Software provides sticky, recurring, predictable revenue to cushion against those wild hardware cycles.
Ah, okay. So the debt was basically a strategic shield against future volatility. But, they still have to pay for that shield.
And that is exactly where the cash flow comes to the rescue. The levered free cash flow for fiscal 2025 is $25.04 billion.
Wow.
They are converting an incredible 41% of their top-line revenue directly into free cash flow. When you generate over $25 billion in pure cash after all your capital expenditures are paid, a $66 billion debt load transforms from an anchor into like a very manageable mortgage.
That cash conversion rate is staggering, 41%. And I guess that explains how they can do so much simultaneously, right? That cash services the debt. It supports their $10 billion share buyback program.
Which artificially reduces the supply of shares on the market, driving the price up.
Right, and it funds their annual dividend of $2.60 per share, which gives them a 0.70% yield.
And keep in mind, they have a 14-year streak of increasing that dividend every single year.
So they have this massive cash generation protecting them. Fundamentally, they are a fortress. But there is often a really sharp disconnect between the fortress a company builds and how aggressively traders try to scale the walls, so to speak.
Oh, absolutely.
Because strong fundamentals don't always mean it's a good time to buy. If we pivot and look at the momentum right now, human psychology seems to have taken over the steering wheel.
Yeah.
So what are the market mechanics telling us? Let's go to the charts.
Well, when we look at how the market is actually pricing the stock today, the trend direction is unambiguously bullish across short, medium, and long-term timeframes. Right now, Broadcom is trading around 371 cents. To put that in perspective, its 50-day simple moving average is $326.61, and its 200-day is $330.13.
Oh, so it's completely detached from its historical baseline. The price action is just violently upward.
It's a classic bullish signal, yeah. And if we look at the key structural levels, there is a very strong horizontal floor or support level established around $331.02, with a secondary deeper safety net at $322.04.
Okay, so that's the floor. What about the ceiling?
On the flip side, the immediate resistance they need to break through is sitting right around the intraday high of $376.55. If it clears that, there isn't major overhead resistance until you get way up to $412.98.
But the momentum indicators aren't all sunshine and rainbows, right? I mean, they're waving a bright red flag.
Yeah, they really are. So the MESID, which measures the relationship between moving averages, is strongly positive at 6.74, which confirms the upward trajectory. But the glaring warning sign, the catch, is the relative strength index, the RSI.
It's sitting at 75.32.
Exactly. For the listener, the RSI is an oscillator that measures the speed and magnitude of recent price changes on a scale of 0 to 100. Generally, any RSI reading over 70 indicates the stock is entering overbought territory.
So it means the buying pressure has just been too intense, too fast.
Right. The stock has sprinted too far ahead of its underlying baseline. Think of a marathon runner who suddenly decides to sprint a 4-minute mile in the middle of the race. The speed is impressive, but physiologically, they have to slow down and catch their breath eventually.
Or, like stretching a rubber band. You can stretch it really far, but at an RSI of 75, that rubber band is incredibly tight. It's either going to snap back or it just has to relax for a while.
That's a great way to put it.
Which brings us to the great debate. With that overbought signal flashing, is the current price just a brilliant trap for retail traders? Or does this whole AI narrative actually justify paying this much of a premium?
Let's look at the ratings and valuation. We have 31 analysts covering this stock, and the consensus is a resounding strong buy.
31 analysts. That's a lot of agreement.
Yeah. Their average price target is $464.32, which implies about a 25% upside from where we are today. And the range of expectations is incredibly wide, going from a low of $314 to a high of $630.
But the valuation multiples are intense. I mean, the price-to-earnings ratio for the trailing 12 months is 72.48.
Right.
That implies absolute perfection. Historically, value investors look for PE ratios in the teens or 20s. Now, I know the market commands a premium for top-tier AI growth stocks right now, but our sources estimate the stock is currently trading at a 22% premium to its actual intrinsic value.
And that tension is the absolute crux of the bull versus bear argument. Let's outline the bull case first. Why would anyone pay 72 times earnings?
Right.
The bulls point straight to AI infrastructure dominance. Broadcom's supply deals with giants like Google and Anthropic have created a revenue run rate that now exceeds $30 billion. That is highly visible, guaranteed cash flowing in.
Yeah.
Combine that with their 41% free cash flow conversion, and you have a cash cow that can fund endless buybacks while marching toward dividend aristocrat status.
So the bulls are essentially saying, ignore the current multiple. Focus on the cash they will be generating 3 years from now. It's a forward-looking bet.
Exactly.
But the bear case carries serious weight, too. The bears are pointing to lagging software growth. We talked about how they bought VMware to diversify and create sticky revenue. But VMware's infrastructure software missed expectations entirely. It grew a measly 1% year over year.
And that 1% is a major point of contention, because if you take on $66 billion in debt to buy a software company, you expect it to be a growth engine, not a stalling engine.
Exactly.
Furthermore, the bears highlight a critical cyclical vulnerability. Right now, the tech sector is in a massive AI capital expenditure, or CapEx, supercycle. Companies are spending hundreds of billions building out these data centers.
Right. But what happens if that CapEx cycle taps the brakes? I mean, if Meta or Google decide they have enough processing power for the next 2 years and reduce their infrastructure spending, Broadcom is highly exposed. The music could stop.
That's the fear. And that cyclical reality is exactly why buying at a 72 PE is inherently risky.
Which brings me to the psychology of the retail trader. If the PE ratio is over 72 and the RSI is over 75, showing it's technically exhausted, aren't retail traders who buy in right now just acting as exit liquidity for the big institutional players?
It's a real danger.
Like, how do you separate a true undervalued growth story from a classic value trap?
To navigate that, you really have to break down the downside risks into two distinct timelines. First, you have to understand the volatility. Broadcom's beta is currently sitting between 1.31 and 1.62.
So just for the listener, beta measures volatility compared to the broader market. So if the S&P 500 drops 1%, Broadcom might drop 1.5% or more. It swings wider than the rest of the market.
Correct. And those wider swings are exactly where retail traders get shaken out. A retail trader sees the AI hype, buys at the absolute peak, and then the stock takes a perfectly normal, healthy 10% dip to cool off its RSI.
And they panic.
Right. The retail trader panics, assumes the AI bubble has popped, and sells at a loss. Meanwhile, the institutional buyers happily scoop up those discounted shares at the support levels.
It is a tale as old as the stock market.
So if we are looking at the short-term outlook, meaning the next few days to weeks, because of that 75 RSI, the stock is highly susceptible to a minor pullback or a period of sideways consolidation. The rubber band needs to unstretch.
Okay, so what are we watching for?
The critical level to watch is whether it can decisively break and hold above that $376.55 resistance. If it fails, we could easily see it drift back down to test the $330 support floor.
Okay, but the medium to long-term outlook tells a radically different story, doesn't it?
Oh, entirely. If your time horizon is months or years, the broader picture remains overwhelmingly positive. According to the projections in our sources, Q2 2026 revenue is expected to hit $22 billion.
Wow.
That would represent a massive 47% year-over-year growth rate.
A $1.7 trillion company growing revenue at 47%. The sheer scale of that is just, it's difficult to process.
And the reason for that projection is simple, really. The custom silicon production for those hyperscalers like Meta and Google is just going into overdrive. The physical architecture of the future internet is being built right now, and Broadcom basically owns the blueprints for the networking layer.
All right, so to synthesize this entire journey for you listening, Broadcom is undoubtedly a cash-generating monster. They have undeniable entrenched dominance in the AI networking space and partnerships that secure their revenue for years.
Absolutely.
But, and this is a big but, you have to respect the immediate reality. The stock is technically stretched in the short term. They are carrying a heavy debt load from a software acquisition that's currently underperforming, and their gross profit margins are shrinking as lower-margin custom chips take over their sales mix.
It perfectly captures the duality of the market, doesn't it? You can have an incredibly great company, but that doesn't mean it trades at a great price on any given Tuesday.
Exactly.
Which leaves us with one final provocative thought.
Well, let's hear it.
Well, we've looked at the technical charts, we've debated the fundamental cash flow, and we've weighed the AI narrative. But the ultimate truth teller in the market is often hidden in the derivatives.
Right.
If you were to analyze the specific options order flow for the very next expiration date, what would it reveal about where the institutional smart money is secretly placing their bets?
Are they quietly buying call options, expecting a breakout past that $376 ceiling? Or are they loading up on puts, preparing for that inevitable gravity-driven pullback?
Exactly. That's the real question.
Now that is the multi-trillion-dollar cliffhanger to leave you with. Sometimes the surface tells one story, while the options chain tells the real one.
Always look deeper.
Thank you so much for joining us on this deep dive into Broadcom. Just a final reminder to please hit the like button, subscribe so you don't miss our next breakdown, and most importantly, drop your thoughts in the comments below. Based on the data, are you buying the AI growth story, holding your ground, or staying far away from this valuation trap? Let us know. Until next time, stay curious.